Hey everybody, happy Friday to you. My name is Brent Moore. It's time for Condors, Calendars, and Butterflies, and we also tackle some different types of strategies in here as well. This is just kind of a general multi-leg option strategy webcast, and we've been going through a series. Each week we're covering kind of a different strategy here to kind of add to a strategy library, if you will. This week we're going to cover double calendars and double diagonals, because we've talked about calendars before, we've talked about diagonals before, and they're a strategy you'll encounter some, and you may find them useful, and maybe you like them, maybe you don't, but you don't know unless you know them. So we're gonna go through that. Good to see some familiar names in the chat. Appreciate you joining me today, and if you're watching on a recording, we're grateful for you as well, of course, and I'm grateful for James. Mr. James Boyd helping me out in the chat. Always appreciate James. If you haven't followed James in the past, make sure you check out his Investing Master series. Occurs on Tuesdays, by the way, Tuesdays at 11 o'clock Eastern Time. You can follow James or myself on X, at Brent Moore CS, at James Boyd CS. We do post additional financial content throughout the week. So, check that out. Glad you guys are here. Hey, let's go through a few disclosures here before we get too far into this. Options do carry a high level of risk and are not suitable for all investors. And the material today is intended for general informational purposes and educational purposes only. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. They won't do that on the Paper Money platform, but in your live account, just realize that that can happen. And so that's one of the differences. The Paper Money software application, which we will be using today, is provided for educational purposes only. And all investing involves risk, including potential loss of principal. Their past performance does not guarantee future results. And Schwab does not recommend the use of technical analysis as a sole means of investment research, although we do use we kind of focus on technical analysis in this class, but just realize there's a lot of other approaches to the market, the trading market here. So just be aware of that. And there's no guarantee that an execution of a stop order will be at or near the stop price. All right, hey, let's move on over. Let's head on over to the Thinkorswim platform. This is the SPX right now. Had a nice little bounce today. You know, all in all, this week has not been a great week in the markets. You can see that. This is our 20-day and our 50-day moving average. But you know what? When we get the bounce, we want to see a bounce. And that's what we see. Now, at this point, what we're going to hope for is we're going to hope for a to break through the most recent high. We'd like to see a higher high here on this. We've struggled a little bit lately, haven't we? Here was our high. In fact, that was an all-time high. Roughly, we're going to call that about the same area as the last one. That would be kind of a key technical break for a bull there. Now, if we don't, it doesn't mean the market is trending down. We could end up in just like this kind of sideways consolidation period here on this. But anyway, that's kind of where we stand technically on the market. Now, I want to talk about, as I mentioned, double calendars, double diagonals. And somebody in the chat, David, said neutral strategies. Yeah, these are neutral strategies. You know, we go through bullish strategies, we go through bearish strategies. In fact, last week we talked about diagonal spreads, which is a directional strategy. Calendars, just plain old single calendars are neutral. Double calendars are neutral, but diagonals, this is going to be neutral as well. So we have all types, and this is not intended. None of these strategies we talk about each week are intended for the majority of your portfolio, but they're different tools in your arsenal, in your trading arsenal. Let's just take a quick look here. I'm going to go with a very common stock that you guys are all familiar with, Amazon. And I want to just talk about a double calendar just to start, and then we'll get to some more specifics on this. Now, something I want to mention is, and something I'm going to get to because I've been JDLMI has been mentioning in the chat, hey, cover scans. I'm not going to cover scans today, but I want to talk to you. I think probably next Wednesday in our managing options portfolio class, I'm going to mention scans to a little more detail. But I do also want to talk to you about how to find some stocks. I'm not necessarily going to be using scans for these stocks, but I'm going to show you how I kind of came up with stocks. So it's kind of getting at the same thing. How do you find stocks is a big thing. But before we get to that, let me just kind of mention, here's Amazon, and I'm going to call this more of a neutral type trade. Now, ask yourself, from a technical analysis standpoint, what you think, what your forecast is on this. Bullish? Bearish? I mean, there's bullish things about it, there's bearish things about it, and you could say that for a lot of stocks, probably. In this case, I'm going to say, well, you know what? There's some bullish things and some bearish things, but really there's not a whole lot. I mean, really, if we go back to, what is this, July? We're basically where we started. Yeah, it's gone up and down some, but every time it goes up a lot, it goes back down, or down a lot, it goes back up. And I'm going to assume that's going to continue. And that's going to be my assumption going forward, is this is going to be more of a neutralish strategy. Now, one factor that often comes up is earnings. I already checked on Amazon. Earnings is on February 5th, if you're concerned with that. We're going to be hitting earnings season here before too long. Just as a reminder, earnings season kind of occurs 4 times a year. After the fourth quarter, so we'll say December 31st, then, you know, the accountants and finance people do their thing, and then they release their earnings. And so you start to get the heavy influx of earnings about the second to third week of the new quarter, which would be about the second to third week of January, is where you will start to see a lot of earnings. So this isn't right at the very beginning of earnings season by any means. This is probably kind of mid earnings season. But anyway, we don't have any in the super near term here on that. But something to check out. It doesn't completely rule out earnings, you know, trading over earnings, but keep in mind, calendar spreads and double calendars are Vega positive trades. They benefit if implied volatilities go up. So if you look at implied volatility and you say, well, implied volatility is kind of maybe on the lower end of things, but with earnings coming up, this was our past earnings, you know, you kind of saw IVs go up. You'd probably expect IVs to go up from here before earnings. That's no guarantee, but it would tend to help this trade. It's not going to make up for a lousy trade. I mean, if Amazon shoots way up or goes way down, it probably doesn't really matter what IV does, but it can make the difference in more of a close cut type situation. So that's what we're going for here on this. We're going to look for something where we think there's maybe some more chances of that implied volatility going up there. So here's what we're going to do. I'm going to go and I'm going to just kind of pull up a double calendar. How do you do that? Well, this is what I'm going to do. I'm going to do a calendar spread, but normally on calendar spreads, the way we've taught you, the way I've kind of taught you is, hey, this is going to be kind of neutral, and you're just going to put the strike price where your target is, okay? Where your target price is for the stock. If you think the stock's going to be at 230, you'd pick a 230 strike. But in this case, we're not just doing 2 calls or 2 puts. We're doing 2 calls and 2 puts. We're doing a call calendar and a put calendar. So when we say double calendar, it's both. It's a call calendar and a put calendar. And we're going to put them both a little bit out of the money. So for example, if the stock is around, we'll just say about 230, we may do a call calendar around the 240. And we may do a put calendar around the 220. I'm just kind of making up these numbers. We'll look a little bit more specifically here in just a sec. But that's kind of what you're going to do. So you're going to have a call calendar, you're going to have a put calendar, and so ultimately what the risk profile is going to look like is it's going to kind of look like this. Okay, we'll see this in just a little bit. This will be where your put strikes are. This will be where your call strikes are, and there we go. Okay, so let me clear that out. Let's do it. Now, so what I'm going to do is I'm just going to kind of go out of the money here on this, and I'm going to go out, I'll go out about 20 days here on this, okay? So very often for our short strike here on this, we'll go out 20 to 40-ish days, maybe sometimes less, sometimes more. There's not a formula. Generally, the longer you go out, I'm especially talking about the long contracts here, the more expensive it's going to be. But in any case, we're going to go out 20 days on this just as an example. Pay attention to liquidity. Amazon's a pretty liquid stock. So even using the weeklies, we're probably doing okay here on this. I'm going to look at my delta. I have a delta column here. And I'm going to do something like 30 to 35-ish delta. Well, we've got a 22 delta. That's certainly not, that's too far. I'm going to go to the 35 delta. 235, and I'm going to sell that, okay? And I'll go and let's go out a little bit. We're going to go out at least a couple weeks longer than where this one is. So that was January 9th. We'll go out, say, January 30th. I'm going to pick that same strike, 235, and we're going to buy that same strike. I'm just going to hold down my control key and click on that, okay? And there we go. So that's the call calendar at 235. Let's look at the put calendar. I'm going to do the same thing. Same expiration dates. I'm going to go here. I'm going to find something 30, 35-ish delta. Well, we got this. That's close enough. 225. And I'm going to sell that. I'm just going to hold down my control key. Just keep in mind, if you're newer with the Thinkorswim platform, if I just click on this bid price without holding down the control key, it's going to overwrite. It's going to replace the other trades I have in there. By holding down the control key, it adds it to those. So now we have 3 legs. That's the 225 strike. And I'm going to go to that same 225 strike, hold down the control key. I'm going to buy that. It's a double calendar spread there. It says double diagonal there. That's what Thinkorswim does, but it's a double calendar because our strikes are the same here. Now, there we go. There's our debit. That's the max. That's our max loss. Our debit represents our max loss. Let's analyze this trade and just take a quick look at it and just kind of look at that. That's what double calendars look like. Now, if I spread my strikes out wider, then it may look something more like this. And if you spread out wide enough, you may even have a loss kind of in the middle between those, okay? Keep in mind, a single calendar would look just kind of like that, right? So let me clear that up because now I'm kind of messing up the screen. But that's kind of traditional double calendar, what double calendar looks like, okay? Now, here's the thing. Let me go and let's talk about reward and risk on this, because this is, remember we said our max loss is about $540. You can see that at the bottom of the screen, and that's right here in case you're looking at that, right? Our max gain isn't so much. Now, the advantage of the double calendar, one of the advantages of the double calendar, there's advantages and disadvantages, is that you end up with a bigger area of, kind of near the max reward. A single calendar may have this like that, right? And you're going, well, what's the odds it's actually going to hit kind of right there? But on this double calendar, the good news is we actually have a fair amount of area. Now, Chris is saying, that reward ain't great compared to the amount of risk we take on it. Yeah, that's the thing. Now, we can always tweak it a little bit and go. So let's just kind of look here. That's about, about $200, we'll say roughly. So we're risking a lot more. Now, it actually has to go a little ways to get there to the max loss, and it would probably require more, typically you're going to have to let time go away, theta to work against you on this for it to get there. But yeah, the reward to risk, that is something to pay attention to. And that's why we look at this, is to, pay attention to that. Now, here's another thing I want to point out. Time decay. One reason people do these is time decay. Well, notice this. Notice the purple line here, and here's the blue line. Where the purple line is below that blue line, that means, hey, as time progresses, this is getting better. That's positive theta right in there. These are all this is a positive theta area, positive theta. But notice it's not positive theta no matter what. If the stock goes against us, it actually gets worse as time goes. Okay, that's negative theta. This is negative theta. So one of the benefits of doing the double calendar is you're doubling the theta. Well, not exactly doubling the theta necessarily, but you're certainly increasing the theta over if you just did the single calendar there. So there we go. Now, one other thing. It doesn't make any sense. Look, we got to break even 221 and we'll say 240. It doesn't make any sense if I don't think the stock is going to be here between those. I just drew in yellow where that is. So we kind of have a support level here maybe. This is up a little ways. How do I shift it? I could shift it down. I could shift the strikes down, right? If I do lower strikes, then we could just shift this whole thing lower. But from your technical standpoint, are you comfortable with that? So that's how that works. And by the way, just let me point out something for you. If you want, on this tab, if you want to do what I just did, and you can just set, I'm going to set my set slices to break even. Okay. I'm going to set my slices to break even. And then what I'm going to do also is I'm going to set my slices to the chart. Set slices to charts, click on that, and there's that. That basically did what I did with those yellow lines manually, with a little more precision than what I did though, okay? So that's just kind of a neutral trade, way to increase your theta, way to increase the area that you can have more money, but that reward to risk is not ideal, okay? Reward to risk is not ideal here on this. So there we go. That's what I just wanted to start off with that. Now, how did I find this stock? Because sometimes people will look at stocks and they'll go, well, I want to find a such and such a trade. And so they want to look directly at the options. Typically with options, we're looking at the underlying stock, especially if you have the mentality of I'm going to care about what the technical analysis is. Okay, so we're going to look at the underlying stock. But we also had this other thing. And that other thing is we wanted IVs to maybe have more potential to go up. So how did I do this? I didn't do a scan. What I did is I just started with a watch list. Okay, let me just actually clear some of this out here because I got some extra stuff here. I'll leave both of those in there for now. You could do whatever watch list you want. S&P 100, if you have one that's called, whatever you want. This is just looking for stocks. This is just one I've saved that just looks for stocks that are penny increment options. They trade a volume of, I think, 8 or 10 million shares a day. Okay, that's all that is. It just limits the list down. The point is, when you're looking at stocks, and you want to limit the list. And if you're looking for a particular type of stock, in this case, we said, well, we want liquid options or liquid stocks that have higher potential for liquid options. We want stocks that are kind of going neutral, okay? And this is, this says nothing about whether they're neutral or not. And I'm looking for stocks that maybe have kind of a lower IV than they typically have, okay? So let's focus in on that IV aspect of it for a sec here. Okay, Chris said, when the IV is high, so iron condors, we'd want, they're both neutral trades. Iron condor is a neutral type trade. We want liquid, no matter what option strategy you're doing, you want liquid stocks. This is the difference. This is one of the big differences. Calendar, double calendar, it doesn't matter. We're Vega positive. We want the IV ideally to go up after we enter the trade. Okay, it doesn't matter if it's gone up before we enter the trade. That's history. We want it to go up after we enter the trade. So the theory is, if you get it when it's low, then it's more likely to revert back to a more normal level. Okay, so I have a couple columns here, and they're both basically labeled the same thing. One is a custom column, one is just the stock column that's available. This one right here, just IV percentile, okay? Technically, that's an IV rank, okay? It calls it IV percentile, technically it's an IV rank. So what that is saying is, compared to its history, where is it in terms of the range of the IV? So let me put it another way. If I go and I pull up add IV to a chart, if this is the absolute high, and this is going to go back a year, I think, on these, okay? If this is the high IV, and we'll see this is maybe the very bottom IV, where is this in that range there? You know, if this range represents 100%, where is it in the range? That's kind of the stock one there. But there's another, sometimes though, you have something that just kind of spikes, and I don't have an example off the top of my head necessarily, but you have something that spikes, and most of the time it's actually higher than it normally is, but it's way lower than the spike. So the IV rank here, this IV percent, what it's called IV percentile, is a little deceptive in that regard. So I have another one here that I've labeled. I need to think of a different label for it, but I truly think of it as an IV percentile. So I just put a couple little asterisks next to it. That is a true IV percentile of what percentage of the time is it below it or above it. So I'll share that with you. Let me just go here and share. And IV percentile, okay? I'm just gonna, I'll type custom next to it just for that, okay? So here's this, and if any of you are interested in this, here's what I'm gonna do. I will put it in the chat for one, okay? If you're watching live, just remember, not guaranteed for accuracy or timing, these scripts that we do. If you are not watching on a recording and you're watching, excuse me, if you are watching on a recording, you can just copy it down from here, okay? That's a $G8NMBAQN. It is case sensitive though, okay? All you need is the exclamation point on. You take that, you copy it, you go up to the gear, you click on open shared item, you paste it in there, click on preview, it may give you a chance to name it, whatever you want, and then you import it, okay? And then you have a column script. So here's long story short. Instead of running a scan, what I'm doing is I'm just taking a watch list. Maybe you've saved it or whatever. And then you can sort by this and look here for this, okay? And yes, David, I will put that in the channel description as well, okay? So we want this to be lower. The theory is if it's lower, it's more likely to revert to a more normal level. Okay. Well, you can see these IV percentile, they're almost all really low. You know, some of them are a little higher. Here's 42, which is a little higher. Bank of America. Well, we have earnings probably coming up closer on Bank of America. Citigroup's a little bit higher. Well, we have earnings coming up on Citigroup. So that IV ramp up that we mentioned before has already kind of taken place partially on these. Now, these are all showing a little, oh, Comcast. Well, Comcast is up pretty high, right? And so there you go. That's how that works. It's not necessarily earnings related, but just more speculation on it. All right. That's how I search for these. And then what I do is I just scroll and I go, oh, that's kind of more neutral, or that, you know, AbbVie looks pretty neutral. Well, I looked at AbbVie. AbbVie liquidity wasn't great, even though it's on my liquid options webcast on some of the options. So I skipped it. You know, and some of these, Abbott looks, you know, maybe a little bit more neutral. But some of these are going to look more trendy when we do this. Okay. And so when we do that, I'm going to go, well, that's not really my neutral trade. That's how all these examples occur. And that's how, in general, I'm finding examples week to week to share with you. Now let's switch it up a little bit here. Okay. Let's take another one that was on the list. Okay. Let's go UNH. Okay. Let's go UNH. And so this is United Health Group. To find earnings, you can always go to the Analyze tab and go to earnings, January 27th. Okay, fair enough. I'm going to go to Analyze. Well, we'll start with the trade tab, then we'll run to Analyze here. Let me just get here. We got a trade. Yeah, that's an old trade there. We're going to do this. Let's do a diagonal. Okay. Again, I'm going to go out. Oh, you know what? Before we do that, let me just kind of do this real quick. Let me just give you kind of a quick rundown. Okay. Double calendars, double diagonals. We combine two calendar or diagonal spreads. Okay. Number two, they're typically a wider range of profitability than single calendars, okay, when we're talking about calendar spreads. Diagonals, not necessarily the case. Diagonals are a little bit more directional. That's a different thing. Positive theta trades, okay, positive theta. Positive vega trades. We've talked about this. Positive vega. Okay, in case you weren't taking notes, you got this here. Short option, and this is just a kind of a very rough rule that we're using in this class, and you'll see I actually violate it a lot. 20 to 40, that's supposed to be 40 days till expiration. Okay. Long options, a couple weeks more than short options, or even more than that. Okay. We'll say at least a couple weeks more than the short options in terms of expiration. Number 7, let's see, we're going to say short strikes, and we're going to say 30 to 35 delta. Now, delta tells us how much the option is going to move in relationship to a $1 move in the stock price. But for our purposes, it's going to give us a sense of how far out of the money to go on that. For long strikes, well, for a calendar, they're going to be same strike. For calendars, for double calendars, same strikes. For long, okay, as short. So for double diagonals, though, we're going to look for something maybe 60 to 70 delta. Okay, I just got a couple more here, I think. The probabilities are going to depend on the strike. We're going to exit or roll at 25 to 50% max gain. And we're also going to exit with a technical breakdown. This is a neutral trade. If it returns bullish on us, significantly bullish or significantly bearish, we're going to get out. Exit technical breakdown. Let's see, do I have anything else? Oh, exit with 10 days, we'll say less than 10 days before expiration. Okay, and then money management, we're going to say we're going to risk 1 to 2%. It's supposed to be a percent of active trading portfolio. Okay, so we'll do that. So that's just kind of a summary. If you wanted to do a screenshot of that, you could. But let's go and look at an example of a double diagonal here. So here's what I'm going to do. I'm going to go out. We said 20 to 40 days. I'll go January 9th here. So that's 21 days till expiration. We do have holidays, a couple extra holiday days in there. So this is kind of a short 21 days because this is calendar days. But there we go. I'm going to go out and we're going to look at our delta. Here's my delta. And I've got a 34 delta here. And I'm going to sell this contract. I'll go to the puts. I'm going to go to, say, a 32 delta. I'm going to sell this contract. Hold down my control key. Okay, so at this point, it looks the same as a double calendar. But then we're going to go out. Okay. And I'm going to go out at least a couple weeks more. We'll go, say, 35 days. And on this one, I'm going to go out and I'm going to look at my delta again. I'm going to go to my calls and we're going in the money. On a calendar, we went out of the money on both calls and puts, both the short contract and the long contract. On our long contracts, we're going in the money here on this. Okay. So here we go. We got, we could do probably either of these. I'll hold down my control key. We'll do that one. And we're going to do one more. We got puts. We're going to go in the money. We're going to go to our delta here and we'll go to about a 63 delta. Okay. Let me hold down my control key. There we go. Okay. So that's our starting point. Let's analyze trade and see what we got. That's not what we want here. We'll do that. Okay, so there we go. That's what it looks like right now. Looks a lot like that double calendar. Same issue, by the way, in terms of reward to risk. Reward, that's like just over a couple $100 there. It gets a little better if we go out to one of the wings, $400 or whatever. But that's pretty small compared to our debit. We can tweak that if we want. So, for example, if we go, well, that I'm okay with not a great reward to risk, but that's just no good. I want to change that. Well, I could go and do, I don't want my long, I want my short. I'm going to do my short. Let's just change this here. Do that. Okay, and see if that changed it here. So now $2,600. And yeah, that's a little better. Okay. Now in the middle, instead of just over a little $200, it's a little bit over $400. Okay, on this. And it actually, that's not the, if it goes out a little wider, then that's okay. We can tweak this to our heart's content here and find a trade that we want. So in this one, we started with that 345 call, and we changed it to 340. What if we do a 325 put and change it to a 330 put? That's going to bring in more premium. And there's that. So what you start with, which was here, may not be what you end up with. Maybe you end up with something a little bit different here. Now we're over $600 in terms of that max gain. It's going to shrink it. In other words, it's going to shrink in our break-even points. But we can look, our break-even's around 353 and around 322. 353, let me get rid of that. 353. That's probably 353, 322, which is about there. That's what it looks like. That's what our forecast has to be on this. This, I'm saying, is more neutral, right? Maybe slight. It's been maybe creeping its way up a little bit. So we're going to call that good. Here's our implied volatility. Again, low. Our earnings is on the 27th of February. So eventually we're going to expect that to reverse itself and go up. May not. But as we go and we, that's the range. So that's how you do that. Okay. Now I'm going to hit some questions here, and then, so we'll tweak that trade because I actually like our modifications. Don't be scared to modify it. That's why you have this Analyze tab, is so that you can modify the trade. 320, 345, 340, 330. Okay. So we said 340 and 330. There's the revised trade, the new and improved trade, I think, over the original one we were looking at. Okay, so question from RB Tech Trader. Are these considered short positions or long positions? Okay, so it's a long position because it's a net debit on this. There are short components of the position, but all in all, we're going to call this a debit trade. Okay, that's both for the calendars we showed and the diagonals that we showed. Okay, all right. I mentioned the active trading portfolio. So here's what I mean by that. You very well may have a big portfolio that maybe has retirement aspects to it that are just kind of your long-term hold or, long-term investment. I don't mean to imply it's necessarily buy and hold, but the more conservative, likely not options aspect of your portfolio. That's not what I'm talking about. A lot of people will have a separate trading portfolio of more active stuff. When you're figuring out position sizes, though, no, it's not cash, because maybe you've invested a lot of it in cash. Maybe let's say your active trading portfolio here. In fact, let me go back to where I mentioned that. I mentioned that here on money management. Okay, this is what we're referring to. Let's say you have an active trading portfolio of, I don't know, $50,000. Okay. So 1 to 2%, we'll say 2%. That would give you about a $1,000 potential risk on any trade. Okay. So there we go. That's the math on that. But where do you 1,000 or 2% of what? 2% of the total portfolio. If I've already invested some of it, that's okay. It's still the total portfolio. Just because I've invested, say, 40,000 of that, I'm only down to 10,000 doesn't mean, and I only have 10,000 left in cash, doesn't mean I need to reduce this down to what would be $200 or whatever. No, you don't need to do that. So I'm hoping that clarifies that question there, David, for you, of the total active trading portfolio. Okay. There we go. Let's go back because we're going to run out of time here. So we tweaked this. This is our double diagonal. I'm going to throw this in. I'm going to put this in. And, oh, I don't have my group set out, so we'll just do that. Okay. So we entered that. We'll put that in. Now, last week, let's revisit last week. For the most part, everyone, by the way, I do a lot of management of these positions in our Managing an Options Portfolio webcast, which occurs on Wednesdays. What did I just do? That's not what I want. I want to put these in the groups. Last week, what we did was we did diagonal spreads. We had 3 diagonal spreads last week. And one of them went well, had a nice little profit in paper money. One of them didn't go so well. We had a loss in paper money. And one of them we still have, and that's CMG, okay? Now, one of the rules we have, and it's doing okay. We're up 120 bucks on this. We could get out. We got 14 days to expiration, so there's no urgency to get out by any means. But once you've made a certain amount of money, you may decide you want to get out. So if I go to Analyze and I go to CMG, here's CMG, and you see where the current stock price is, that is, you can see we've actually made probably most of what, well, we've made a half of what we can make here on this. Okay? And a lot of times we'll get out. We'll just take the money on that one and go, okay? Because we've made half of what we can make. There's risk in holding on to it, and we'll call that good, okay? So we certainly could get out here. I want to bring this up also in our my Managing an Options Portfolio class. So I'm actually going to hold off a few days and not exit it right now. But if you were following along in your paper money account or whatever, you are welcome to, some traders would consider just taking your profits at this point because that one's gone. We're still in that one, but I'm going to hold on to that for that reason. We do have exit trades in place on that. But anyway, that's the update on that. If we wanted to, if you wanted more detail, you can go back to last week was the 12th, and we did these 3 trades. We did CrowdStrike, Dow, and we did CMG. You can see we got out of CrowdStrike, we got out of Dow, and we're still in CMG. All right. So there we go, everybody. That's, that's just a variation of a trade we've already done. We've already talked about calendars. We've talked about diagonals. You'll see people do these double diagonals, double calendars. They're truly a neutral trade where you can ramp up the time decay, but just realize the reward to risk may not be on your side there. Okay. Last question there. Does the IV percentage 7.9% the historical values than the present? It means that it is, if your IV percentile is the one I shared with you, okay, that's the custom one. If it's at 7.9%, I'll just say 8%. What that means is it's very low. It means 92% of the time, it's been higher than where it's currently at. So for example, if you take something that's low here, do I see anything here? Well, go NEE. It's not a perfect, it's not exactly This is at 4%. That means 96% of the time, the IV-has been higher than that. You see that? Okay, everybody, thanks for joining me. Hey, make sure you subscribe and like. And when I say subscribe to that Trader Talks channel. That way you can see, you won't miss future episodes on that. We appreciate you. Thanks, James, for helping me out. And coming up next, we've got market and sector analysis. Everybody have a nice weekend. And if I don't talk to you before then, nice holiday season and Christmas and everything. Bye-bye, everybody.